What's up, everybody? My name is Dimitri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guests in this episode of Hidden Forces are Vance Spencer and Michael Anderson. Mike and Vance are the founders of Framework Ventures and have been on the podcast twice before, once to talk about their work in decentralized finance, and the other time to talk about their investments in blockchain-based gaming. You can find both of those appearances in the related tab on this week's episode page at hiddenforces.io. A week ago, Vance got a call, out of the blue, from none other than Sam Bankman-Fried. The two had never spoken before, but Vance had become recently critical of Sam's efforts to lobby Washington for regulation that many felt would benefit him and his companies at the expense of everyone else in the industry. The legislation that he was pushing for would be particularly detrimental to the ecosystem of crypto known as decentralized finance, or DeFi for short. Cashing in on the tens of millions of dollars that he spent to curry favor with lawmakers, Fried spent his time behind the scenes persuading them to pass a bill known as the Digital Commodities Consumer Protection Act. Sponsored by Senators Debbie Stabenow and John Boozman, the DCCPA would, according to some of its critics, make it impossible for open source developers to function within the U.S., limit access to decentralized financial products and applications for U.S. consumers, and create a regulatory monopoly for FTX in the United States. On their call, Sam stated multiple times that if the bill didn't go through, the SEC was going to come after everyone. It was going to come after the DeFi projects, and it was going to come after some of Framework's own investments, and that they would be, quote, materially harmed if they did not get on side, end quote. This was apparently the narrative being pushed by Sam Bankman-Fried in the months leading up to this phone call. It's what Ryan Selkis, founder of crypto market intelligence firm Messari, described in a recent tweet as a, quote, committed contingent of crypto policy people that want you to know that the big bad wolf of Gary Gensler is coming to get you if the DCCPA doesn't pass, end quote. At the same time, there were rumors circulating that regulators were somehow working on behalf of SBF. Specifically, U.S. Representative Tom Emmer of Minnesota tweeted out a few days ago that there were reports coming into his office suggesting that the chairman of the SEC was, quote, helping SBF and FTX work on legal loopholes to obtain a regulatory monopoly, end quote. I want to make absolutely clear that there is no evidence I have seen that supports Tom Emmer's assertions. No one on this call, not me or Michael or Vance, is saying that. None of us know all the facts here. But what we do know, and what I can tell you, is that this disaster, and it is a disaster, inflames every single bias and suspicion that most Americans have about their government and the corrupting influence of money in Washington. It's at the heart of everything that's gone wrong with our political system, and it's a big part of why extremists on both the left and right of the political spectrum have gained the support of an electorate that is itself becoming increasingly radicalized. My sincere hope with this conversation, as well as my recent episode with Mark Cohodes, is to not only tell a story that is itself newsworthy, but to prevent the narrative from being reshaped and repackaged as yet another case of some rogue, evil genius who we can easily blame for a problem that's primarily systemic in nature. Yes, Sam Bankman-Fried is a bad dude, but our system rewards bad dudes, and too often it punishes good ones. We need to change that. I'm going to continue to cover this story as it evolves, and I'm going to try and do that in a way that's not only principled and accountable to the facts, but that's also constructive in its approach. I'm not interested in demonizing Sam Bankman-Fried. My heart goes out to his family. This must be a nightmare for them. Nor am I interested in demonizing the regulators or anyone else involved in any aspect of this story. I just want a fair process like everyone else. And I don't think that's too much to ask, but I'm not asking, and you shouldn't either. If we want to see a positive change in our country, whether it's in crypto, finance, in the media, or in the nation's capital, We have to work together constructively on fixing the problem. We have to hold people accountable, including ourselves, because in a democracy, there is no one else. And with that, I hope you enjoy this latest episode with my guests, Michael Anderson and Vance Spencer. Michael Anderson and Vance Spencer, welcome back to Hidden Forces.
Thank you for having us. Good to be here.
Good to be here.
I feel like the gods of crypto have shined on me today. We had this already scheduled to talk about the SBF FTX fiasco, and I actually just finished recording an episode yesterday with Mark Cohodes, a renowned short seller who has been investigating this story for almost a year now and has been speaking out on Twitter since May about FTX and calling it a scam. That was a fascinating conversation. And I just find out as I'm walking into the studio that, Vance, you got off a call with SBF this Saturday. So just give us an update right at the top about that before we kind of try to do a full timeline of this story. So what was that about? How did that come about? How did that happen?
Yeah, so how it came about, Michael and I, like Mark Cohodes, have been very suspicious of SBF for a long time. And there was kind of this like culture of silence in crypto around not opposing him, opposing his views. And it was that way because he controlled so much of the balance sheet, allegedly, of crypto that, he could really hurt you. He could exclude you from projects. He could exclude you from rounds. And there was a lot of money to be made within his arc, but we never really signed up for that. And then when the DCCPA legislation started to come out, that was when we kind of decided that it was enough. He was trying to basically regulate DeFi out of existence, build a regulatory moat for himself. And so we were pretty publicly not in favor of what they were doing. We were the first real big fund to break ranks and publicly post that we were not supporting it and that we were going to try to do everything that we could to block the legislation. Went after SBF on Twitter, went after Mark Wengen, who was, I think, like chief regulatory policy. If you look at the Maxine Waters video where Maxine Waters is literally blowing SBF a kiss, Mark Wengen is right behind him when that's happening. And yeah,
he came in before Dan Friedberg, who's the other guy, his head of regulatory.
Like Mark Wengen is the guy who's with him in all these regulatory conversations on Capitol Hill. I don't know if he's like actually the chief regulatory officer, but I just kind of kept going after him. And a DM popped in my Twitter DMs, I think right after I sent that last Mark Wengen tweet. And he said, let's hop on a call. And,
what day was this? And you're saying SBF DM'd you on
Twitter? Yeah, let me pull it up. So it was November 4th. Yeah, that was Saturday. And he basically wanted to talk about DCCPA. And we talked about it for 20 minutes, 18 minutes Saturday. And, the basic conversation was him trying to gaslight me on DCCPA again. And then saying, if this doesn't go through, the SEC is going to come after everyone, come after, the DeFi projects, come after Frameworks DeFi projects. And that, we would be materially harmed if we didn't, get on side and then get this passed. And yeah, I'd never talked to SBF before. I expected him to be Bill Gates, Warren Buffett-esque, but what I got was someone that didn't really know the ins and outs of DCCPA, was kind of stumbling over his own words. And I left the call not only kind of just with a bad taste in my mouth, it left me with the feeling that SBF really didn't know, how to control his empire or what all the moving pieces really were.
How long was the call for?
18 minutes.
And this was the first time you ever spoke to him?
Yep.
Wow. So this was happening as stuff was falling apart, but he hadn't been public about it. We didn't know yet, really. Or how far had things come along by that point?
There were rumors last week that they might be insolvent, but you have to really wind back the clock to around mid-October to understand when this started. When he pushed out DCCPA and everyone vocally got against him, that felt like what potentially was preceding this bank run. A change in sentiment, a change in people's attitudes towards how safe it is, him trying to basically quell down the masses to stop any avalanche of public sentiment and funds being withdrawn from the platform. And so it looks like, if I were to really wind back the tape, what was he doing with the DCCPA? He was probably insolvent by June. Was that some sort of last ditch regulatory effort to shore up everything and win by default? Maybe he gets the FTX raise done after that, and that's part of it. And you look at these videos of him in Congress, Maxine Waters blowing him kisses, him next to Chuck Schumer. All of this stuff is just disgusting. It's awful.
Yeah, so I have so many questions about this. I can't remember who it was. There's a congressman or a senator that tweeted out that he had some information or had some reason to believe that
Tom Emmer.
Right, that Sam Bankman-Fried was trying to get some kind of legal monopoly over the crypto industry. I didn't really understand what the context was. Are you familiar with this, and can you fill me in on it? And both of you guys, by the way, I mean, for listeners, Michael Anderson's on the call, who I introduced at the beginning, but he hasn't said a peep yet. So
I'm here.
Yeah, so feel free to answer that however you guys like, and we'll kind of back our way into this conversation. But what was that tweet about? What do we know about that, and what is the relevancy there?
I think that tweet is, we don't have any inside bait. Like, when I came out with the, there was, I don't know if it's a famous tweet. I don't know how you would even categorize it, but I came out with a tweet that basically said FTX and a shadow cabal is trying to make this legislation a reality and, build this regulatory monopoly around themselves. And people were telling us that, you're being hyperbolic. Like, obviously when you throw around the words like deep state, it doesn't come off that well. But that was really the only way that we could express how we were feeling about what the legislative process was and what his relationships with lawmakers were.
How far back did this process go from what we know? Like, how far back was he lobbying the government to try to move legislation in a direction that benefited him or benefited more centralized financial intermediaries in crypto?
At least a year. Like his tweets around and comments around, I'm going to spend $1 billion in the midterms or $1 billion against, the presidential election. That was like a last year thing. And so it's been going on for at least a year. And we don't have any inside baseball as to how the whole process is unfolded. But, towards the, October, year end range, it just became clear that there was something rotten that was happening here. Sam was, from the people who work at DC for crypto, apparently trying to sell out the industry. And I think that's more of what the Tom Emmer tweet is about. It's not about anything that we know, but his response, I would assume, is about SBF's relationships, how he got them, how they're manifesting in legislation. There's a lot of open questions.
One thing that I wanted to add is just what the DCCPA is or was as a draft and why it was potentially, disastrous to portions of the industry and specific portions of the industry that we have been very vocal. And we've talked with you, Dimitri, multiple times now about, which is decentralized finance. In lieu of centralized, unregulated finance, which is what FTX.com was and what blew up, our view is that DeFi, decentralized finance, has a competitive advantage against centralized finance because it's transparent, it's open, people can audit it. This is a major innovation in financial services. And that's frankly one of the reasons why we are promoting it so heavily is because of situations like this. You can't audit, a company that is a black box in the same way that you can a protocol that lives on chain. And the DCCPA would have effectively made anything decentralized effectively illegal in the eyes of the CFTC or any other regulator. It just would have been impossible for it to be regulated in the view of that legislation. And so it made total sense that SBF was promoting this because it would have given a regulatory moat for FTX that would have had an advantage over anything decentralized and basically effectively given them a regulatory monopoly. So just to hammer on this point, it's possible that the reason why specifically along this timeline was we knew that FTX was trying to raise for the past year. It had been unsuccessful so far. It's possible that with the DCCPA in the way that it was written would have given them the mandate to go off and raise billions of dollars to fill the gap, to fill the hole.
Yes.
I do want to talk about that, guys. Before we do, the larger thing I want to do before we get there is to actually tell this story as best as we can of what we know has happened so far. But before we even do that, quick question. How weird is it that the founder of a company that's just gone bankrupt, that was extremely non-transparent, whose chief compliance officer, Dan Friedberg, was involved in the ultimate bet scandal from a decade ago, whose co-founder, Gary Wang, this guy Gary Wang, nobody's heard of him. He's got a profile picture facing a computer monitor with his back towards the camera. That these guys and every other shady character involved in this company were the ones leading the push to regulate this industry. And it wasn't Brian Armstrong over at Coinbase who was out recently saying, the only reason we're not blowing up is because we're regulated. So I find that kind of weird, right? There's this weird sort of thing where the regulators haven't really taken the steps to regulate the industry, which has led to a lot of actors like FTX showing up offshore and kind of doing all this shady stuff. And then these same actors come back around the other direction to sponsor the regulations that are going to regulate the industry that supposedly the regulators haven't really wanted to regulate. So I help square that circle for me.
One very, very clear point that we need to make here is Coinbase is regulated. It's a publicly traded company. It has to go through filings. It has to go through accounting practices. And let's just be very clear. Sam was trying to create regulation that would have allowed him to create a Ponzi scheme that moves from the Bahamas to the United States. That's really what this was.
Explain that to me.
So it's abundantly clear now that FTX.com was a Ponzi scheme. What the DCCPA was attempting to do was to give a regulatory moat to actors that are existing not in the United States to move into the United States. There are already publicly traded, regulated, upstanding institutions like Coinbase that exist in the United States right now that serve US customers. FTX.com did not serve US customers. FTX.US served US customers. That's a totally separate situation. That's a totally separate company. We'll find out what happens to FTX.US. And they contend that their assets are backed one-to-one. But FTX.com is the entity in question here. Alameda is also affiliated with FTX.com. That's really kind of the situation that we're talking about. What this push was a push to effectively build a freeway to be able to bring FTX.com into the United States to serve US customers. That would have been disastrous.
Fascinating. Vance, do you have any thoughts on that?
I'm honestly just thinking about like the lies and the corruption and how deep this goes and who is involved and how the politicians were persuaded that this was the right thing to do. He's the second largest donor behind George Soros to the Democrats. Like, you hear about these conspiracy theories in the deep state and, like stealing elections. And I just think these people are crazy. I don't believe in that stuff. But, now we have this example that's so front and center for us personally that like my faith in government, in regulators and legislators, very much damaged. That's what I'm thinking through right now. That's a little bit, neither here nor there.
So guys, how far back does this go? Like if we want to tell this story for people because one of the things I've also wanted to do is make these podcasts accessible to people that don't really have a sense of the backstory here. Where does this story begin? I mean, there's obviously an important point in the middle of the summer when it may be that FTX went effectively bankrupt or Alameda went bankrupt and FTX bailed out Alameda with customer funds. This is speculation. I don't know. It's a tenuous conclusion that I'm working off of based on everything that I've read and seen. That's one important milestone in this conversation. But how far back can we go? What is your understanding of the origin of all of this? Where did this guy come from? How did he make his money? How did Alameda Research and FTX come into being?
So the first time that I heard of Sam was around 2018. And what I heard was that he was in Hong Kong. He was managing all of his books on a Google spreadsheet. Alameda, put out this really aggressive deck and tried to raise on it, saying that there was no risk in any of the strategies that they had, and that, you could give them loans and it was, no risk. And everyone saw this deck in the venture community and kind of like bristled at it. You don't really see that level of psychopathy in crypto, even though we have, this rep of being the Wild West too often. And so they started out as this market making firm. And, the story is that they were doing this kimchi premium arb trade where they would buy and sell Bitcoin out of Korea. And Korea is a place where the financial guardrails and rails generally are very restrictive, and you need to be a citizen to trade within it. And there's rules about withdrawing outside of it. And, the whole Alameda story is that, we ran this arb trade over and over and over again, and we made billions. Like Michael and I have been in crypto markets for over a decade at this point. The kimchi premium trade is not something that you can make billions on. It's like a 1 basis point trade every once in a while. And that was the whole origin story. And that was the first thing that was fishy. It's like, how did you get all of this money? Oh, we made it in the kimchi premium trade. How does it work? Well, the price moves and then we arb it. And, there really was no explanation there. And when we'd heard that they'd blown up a couple of times or had some financial issues, but that was kind of the last we heard of them until 2019. 2019 is when I think they started FTX, the exchange. And, it was this very aggressive exchange. All of the news stories that came out at the start were that, they were KYCing people extremely aggressively. They also had a like a tier where you didn't need to KYC and you could withdraw a lot of money each day. And that seemed just like in flagrant violation of the Bank Secrecy Act. And so we naturally never decided to do business with SAM. We never decided to KYC on FTX's Framework Ventures. We never decided to trade against Alameda. We didn't hold any of the Solana or Serum tokens. But, from 2019, that was kind of the year of FTX. 2020 is when Sam got involved in DeFi. And DeFi Summer was this amazing Cambrian explosion of new ideas and protocols and ways of using crypto, and issuing tokens and starting protocols was one of them. He launched Serum, he launched FTT, he bought Blockfolio with FTT, an asset he hypothecated out of thin air, and the empire grew. Blockfolio became his mobile app where he onboarded a lot of people through the funnel. He started FTX US during 2020, I believe. And it was just the year of Sam. On billboards, on posters, Giselle and Tom Brady are there. 2021, the hype cycle even increases larger. He's trying to put money in to buy Twitter. The whole time, what Michael and I were thinking is like, what are we missing? All of our investor friends are making fun of us. You're not in FTX, you're not in Solana, you're not in Serum. How are you missing this wave? But for us, it just felt incredibly sketchy. There was no explanation for where the funds came from. We had heard that they were trading against their customers. We knew that they had all of the liquidations on their platform visible to their Alameda trading operation. And we just never decided to really go there. And so that's the story. And, the recent history is that it looks like during the Luna collapse, Alameda blew up. There was some sort of hole in that balance sheet that they plugged with customer funds from FTX, and they've been functionally insolvent since the summer. And the question now is, where did the money go? You're short almost $10 billion of customer assets. Mechanically, it's very hard to lose that much money in crypto markets. They just are not that liquid where you can buy a few billion of something at the top and lose it. And so fraud, embezzlement, all of those words come to mind in terms of where we are right now.
Only thing that I'd add is during this entire period of time, it's not like we were sitting back and just saying, no thanks, no way. We explored investing in the seed round of Serum. We explored investing in, I think it was the second round, I don't know if it was called the Series A, of FTT. All of these things were things that we took a pretty deep dive on because, at the time we were investing in everything DeFi. But when, for instance, Serum came out, and I went back and checked it last night, had a conversation with them in July of 2020, right as DeFi Summer was hitting its fever pitch, and they came and pitched us on investing in the new centralized limit order book of what would become the SBF/Solana ecosystem, which is the new model for how you do DeFi. It's moving off of Ethereum. It's all going to be on Solana. It's going to be backed implicitly by Alameda and SBF. And we're creating this thing called Serum, which is going to be the new derivatives exchange that powers this entire industry. We looked at it, they were raising, and some of these valuations in hindsight, now probably don't seem as astronomical, but at the time it was probably 10 times higher than anything that we'd seen before. They were raising at a $500 million fully diluted valuation. They'd have 1% of the float open initially, and then they would vest over 7 years. And all of those numbers were just order of magnitude higher or lower than what we would have seen with any other reasonable approach. And because of that, we smelled something fishy. Because of that, we looked at it and said, there's something up here. It's a little bit weird. And ultimately, what we came to realize up until now is that was one of the core assets that they were using to backstop this entire Ponzi scheme. That it was FTT and SRM that were being used as collateral, locked or unlocked, to borrow massive amounts of assets. To Vance's point, what happened to the $10 billion? What happened to all of this? Well, it seems like someone was probably giving them someone was giving them access to collateral or access to assets with that backed as collateral, which just seems in hindsight so foolish. But that's kind of the way that things were working. Whether or not that was Alameda, whether or not that was somebody else, I think we'll find it out once the dust settles. But right now it looks like Serum, FTT were kind of the core assets that were involved in this entire thing.
So FTT is the native token of FTX. SRM is the native token of Serum. I'm still not entirely clear on what Serum is and how it fits into this whole picture. I don't know, Vance, do you want to jump in here?
Let me explain how we think this worked so that it's a little bit more clear. So FTT is a token that accrues, like, Michael, what percentage of the revenue of the exchanges accrue?
I believe it's 25.
25%. So it accrued about, I think it's like 20 to 25%. We'll check the exact numbers in a second, but the token accrues 20 to 25% of the revenue of FTX International Exchange, so not the US exchange. And so every week, what they do for the money that FTX makes, they take 20 to 25% of it and they buy FTT on the market and they burn it. And every week, Sam Bankman-Fried would tweet out that he was burning, this money. He was taking the revenue from the FTX exchange. It was supposed to be this very bullish thesis for FTT. And you can find these tweets and they look ridiculous in hindsight. It clearly looks like a fraud. And so FTT was one of the assets. Alameda Research, the other firm, that Sam ran, controlled most of the float of FTT. And so it's kind of this very circular, self-referential thing. So that's FTT. I'm going to put it down for a second conceptually, talk about Serum. Serum is an asset. It's a central limit order book. The asset SRM is the token which accrues fees from SRM, from Serum, the central limit order book that's built on Solana. And it's the governance token. So it trades and it has a large fully diluted valuation. It came out, the starting valuation that it came out at was $100 billion into the market. And it had a 7-year lockup cycle. And so what that means is that, obviously the tokens didn't come onto market immediately, but you had their investors that were slowly dumping all of the tokens into the market. And it was a very low percentage of the fully diluted market cap that was the float of this thing. Okay, so I've explained FTT and I've explained Serum. Alameda Research had large amounts of both of these assets. It controlled most of the float of FTT. It controlled a lot of the float of Serum. What they would do with their Serum tokens is they would give them to lenders, Voyager, BlockFi, Genesis, and they would borrow against it. Why is this problematic? The fully diluted valuations of these things are so high, and you're borrowing against such a high loan to value ratio that if the price of Serum or FTT drops, you're in trouble. Okay, so that's the basic framework. Let's go into the summer of what happened. In the summer, Luna blew up. There's all this forced selling. All the prices of these tokens went down substantially. Who was holding on to a lot of FTT? Voyager, BlockFi. Okay. Why would Alameda Research and FTX go off and rescue them? If they don't rescue them, that FTT and that Serum, very illiquid, hits the market, blows up all their other lending positions, blows up their balance sheet, and blows up their customer deposits. And so that's why they bailed them out, we think. They wanted to keep these tokens from hitting the market. And so their altruistic, quote unquote, bailout offer of Voyager and BlockFi, we believe, was just a scam to try to keep them from selling this on the open market so they could perpetrate this fraud for even longer. So that's kind of where we find everything right now.
So let me see if I can. Okay. And then I would love for you to bring the whole CZ thing in, because that was the shotgun wedding that wasn't. It was like a 24-hour romance. Not really. And I want to talk about that as well. So what you're describing here, if I have this correctly, is that at its heart, FTX and Alameda Research were both really Ponzi schemes that use their Ponzi asset to extract liquidity from third parties, which then basically went bankrupt. And FTX Alameda stepped in to buy them to prevent their Ponzi asset from dumping onto the market, which would cause them to go bankrupt. And they did that by raiding customer accounts on the exchange platform FTX to fund the acquisition. And then from the summer, from when this happened to today, they basically ran out of money, or they got close to running out of money, close enough that maybe it was CZ who decided to push them over the cliff. I mean, first of all, is that correct? And how did they reach a point of illiquidity today or insolvency? What happened? How did they reach to the place that they are now?
Mechanically, they have these huge price drops, which means that their Ponzi tokens, FTT and Serum, which are standing at the other lenders, are now potentially being forcefully sold into the market. So they bail them out to stop that. And so the fraud is going at that point in the midsummer. And so, I'm just thinking through, like, if I'm Sam, what do I do? And obviously I would never do this, but, what are your options? You raise money for FTX, but guess what? It's the middle of a bear market. Interest rates are super high. Nobody's really trying to fund late growth stage companies that are trying to raise at a flat valuation of $34 billion relative to last year. 2.5 times how much Coinbase is worth. Not going to happen. So what does he need? Potentially a big regulatory win, something to enshrine his place in the market, to protect his image, to further the idea that he's the golden boy of this industry. And so I think DCCPA is kind of like his Hail Mary.
Well, so he started pushing that over the
Yes.
summer?
Yes, he's been pushing it for a
I see.
year, but like this is when it really started to pick up steam.
I think just one point of clarification. He's been very active, probably the most active, actually by far the most active person from the crypto industry in DC over the last year. And I'm not sure that it was necessarily his idea to start pushing DCCPA a year ago. But what I think he understood he was doing was buying himself enough clout to, if in a bind, if in a pinch, be able to have this Hail Mary option, but also potentially have something else if something else came up. And who knows what it could have been. But I think this is something that he's been planning for a while. And it just came down to this being the moment that he had to pull that card.
And one other thing that is important to know about SBF is, and I realized this through a tidbit of an interview I watched of his late last night, but there's this interesting interview where he describes this concept called the St. Petersburg paradox. I don't know if you've ever heard of this, Dimitri.
I have heard of this. And
It's a game which basically measures your risk tolerance. And so the game is something like this. There's a coin toss, and every time it lands on heads, you win $10. And every single time you flip the coin, you square the reward that you would get. So the first toss, you'd get $2. The second toss, you'd get you get $4. The next toss, you'd get $14. The one after that, you'd get, $164. And the question with the St. Petersburg paradox is, how much would you pay to play? There's some people who see, the chance to win $2, and it's a 50% chance on your first toss, so they'd bid $1. There's other people who see, infinite upside. And if you take a huge risk and pay a lot, potentially you can completely change your surroundings. So this is a guy who, during this interview said, he wants to play the St. Petersburg paradox. He would pay a lot for it. He's always open to the idea that if you throw a Hail Mary, maybe you'll find yourself in an entirely different place. Like, that is SBF. He's a very mathematical, calculated person with a huge risk appetite. And so that fits.
Well, he described, did you guys hear, was that the Odd Lots interview that you're talking about, with the one that he was on with Matt Levine?
I was reading the transcript.
I feel like I've heard him talk about this on an episode, whether it was that one or something else. But in that Levine episode, that's the famous episode where he described yield farming as this like box that does nothing, and that you just put stuff into the box. And the more people put stuff into the box, the more you can give back out of the. He was describing a Ponzi scheme. And it was weird for everybody on the call. So it sounded like from the beginning, like he had this idea in his head that the path to success here, or success for him, would be bootstrapping a Ponzi scheme, using Ponzi dynamics to win, to just become so big that he becomes everything. That was kind of the vision. I mean, do you agree with that?
Machiavellian perspective of what he was thinking, or what he must have been thinking. I mean, he's a self-described effective altruist, which basically means that he has constant ends justifying the means if they're for a good cause. And it seems like, the $9.4 billion of customer assets were the means, and it justifies the ends. I mean, it's terrible, but he effectively, on that Odd Lots podcast, described the Ponzi scheme that he was perpetrating at that point in time. He described it live on camera. So it's pretty terrible to go back and read the transcripts and think about all the stuff that was going on and do the timeline of, well, what must he have been thinking at this point in time? I mean, he bid $5 billion for Twitter in August. He didn't have $5 billion in August. He probably had negative $5 billion. It's all a charade, a house of cards, and it all came crashing down very suddenly over the last weekend. So we're going to be picking up the pieces for a long time, but it's flabbergasting to think about some of the stuff that was being perpetrated while he was publicly saying different things.
So that, like, the $5 billion to Twitter, this is like a great segue. So, like, where is Sam late summer? We'll call it August. Alameda's insolvent. We're starting to get calls from our friends in DC who are telling us, hey, we know you guys don't really get involved in this stuff too much, but Sam is trying to sell the industry out right now. You guys need to get involved. He's bidding $5 billion for Twitter. So he's got this huge hole. He's trying to throw these huge Hail Marys. And, how does he do it? He donates $40 million to the Democratic Party during the midterms. Are those customer deposits? Whose money is that? Unbelievable.
I mean, it's amazing that he was the number 2 booster to Joe Biden, behind George Soros.
Right.
Like, talk about
institutional corruption at the highest
level.
That
rings every single conspiracy bell,
We don't want to be those people, but, like,
No, and I'm not saying it, even the point about George Soros, I'm not saying it because I'm promoting those conspiracies. What I'm saying is that like those conspiracists point to George Soros as being like the kingmaker of the global elite. And here's Sam Bankman-Fried slipping in as number two. It's incredible. This guy that came out of nowhere, who's 30 years old today, multimillionaire sleeping on a sofa futon in the Bahamas.
He's got a penthouse in the Bahamas. He's got $200 million of property in the Bahamas. The futon, the Corolla, all of that shit with an image that was made up for our consumption, and people bought it. Hook, line, and sinker. Unbelievable.
Time and again.
I think the big question now is, what happens from all of this? What are the ramifications? What are the second order effects from all of this? And I think that there's two. Obviously, there's going to be some sort of regulatory perspective coming out of this. It definitely, there was an article today calling into question all the people that were supported by the people that SBF effectively put into office. What's going to happen to those people? What's going to happen to, those politicians? What questions are they going to have to answer? The other questions that I'm very curious to have are, with people that support us, with our limited partners, our investors, what other people were involved in this? What did they know? What did they miss? How big of a miss was it? And those are going to be the questions that our LPs are going to have to ask other managers, because that I think is going to be a really, really important discussion that everybody's going to have. There's so much to this that is going to have to unravel over the next couple of years.
Totally. And just to kind of support your point, have you guys seen any of the stuff that's like still circulating and still on Sequoia's website?
He's a trillionaire.
Have you seen this
$1 trillion?
I can't read some of it because it's not appropriate. Like the things that some of the partners were saying about their experience of like hearing Sam Bankman-Fried present and talk. And this is not unique to FTX, right? Like this is stuff we've talked about on the show with GameStop and AMC and the meme stock craze and the financial nihilism. This has been going on for years now. It's what happens when you make money free. And basically when profits don't matter and it's all about asset price appreciation, what matters is who can tell the best story, right? And it makes sense that Sam Bankman-Fried's idea of how to generate wealth was to create a box and get people to put money in it.
Okay. But wait. Before we get into it, let's go through the last part of the timeline.
Yeah.
October, DCCPA gets in the limelight. People start throwing up on it. We start vocally bashing him and this idea of this bill. Nothing really happens for a little bit. Mark Wengen, the regulatory person, is tweeting at me on Twitter. I'm tweeting back at him. Basically kind of like this covert war to try to take this thing down. Flash forward to about a week ago, we start to hear rumors that potentially FTX might have problems that are bigger than other people might know. We don't really do anything. We don't have any funds on FTX. We don't have any of the assets that they held or invested in. So we don't really do much. And then we see the CZ tweet. And the CZ tweet is basically, once upon a time, CZ and SBF were besties. They they were the only strategic investor into FTX. FTX tokens, like Move or Volatility BTC tokens, used to trade on Binance. I believe that they used to have stock tokens, which also traded on Binance, and they were best buddies. And so they had a lover's quarrel of some sort. And, 2 years later, after this investment, after they had, parted ways, CZ decided to sell $500 million of FTT, which is one of the Ponzi tokens that I laid out. And FTT was the token that CZ got from the investment back.
Right. So there's another really, really crucial point, though, which is in between, we started hearing murmurs. CoinDesk leaked the balance sheet of Alameda from June 30th this year, which suggested that Alameda was either close to or already insolvent. Alameda and FTX are intrinsically tied. It's always been, we're at an arm's distance away. There's separate entities, different CEOs, et cetera, et cetera. Turns out they're all interconnected. This is like the biggest open secret in crypto. But it also turns out that Alameda had been insolvent basically since the summer. And that balance sheet leaking was the final match that lit everything up. And then CZ started coming in and saying, hey, what's going on here? And then, for the equity that he sold back from FTX, he got FTT and cash from it. And so that was like the final straw. But I think, the other major point to bring up is that FTX is one thing. Alameda was supposedly another thing, but in reality, they're the same thing. And I think that's effectively where Over the last 6 months since Three Arrows and Luna crashed, the market for borrow for crypto assets has effectively been dead. You can get, some money out, you can over collateralize borrow, but the ways that everything was operating over the last 2 years up until June of this year, that was gone. And so who else was going to perpetrate this, asset movement, asset borrow lend? The only other entity that was able to do that was Alameda. And so Alameda, in our minds, was probably the one who's on the hook for a lot of this borrow, for a lot of this lending, and it's just assets moving back and forth. But it turns out, after this leak, that Alameda was insolvent. So where did the $10 billion go? Probably to Alameda.
So the $10 billion you're talking about are $10 billion in customer funds that are missing?
Yes.
And we've established that these funds are
by the
missing.
Wall Street Journal last night.
There were, as of last week, $16 billion in customer deposits. So when you look at the bankruptcy filing in the Bahamas and it lists what are the liabilities that are being sought, it's a $10 to $50 billion hole.
$10 to $50 billion hole. What are those liabilities besides customer deposits?
So this is something very important to understand about crypto. There's two types of wipeouts. The first type of wipeout is when a fund blows up. And when a fund blows up, usually what that means is that they were over leveraged. And what being over leveraged mean is they were borrowing from somebody, and that somebody realizes that they then have a hole in their balance sheet. They need to turn around and sell a bunch of crypto into the market and basically recollateralize themselves. And that's what happened with Luna and Three Arrows. This time, it's different. We're in the second type of bankruptcy, which is exchange insolvency. You're not wondering who the creditors are at this point. You know that the money is just the customer deposits, and the customers can't turn around and sell assets that they don't have. And so there's not the same domino risk of contagion with the creditors like there was this summer. Like the hole in Genesis this time is much smaller than the hole last summer. But what does happen in these scenarios is that the chance of bank runs on other exchanges goes up, because most of the exchanges are not one-to-one backed. They're not located in the US. They're not under an OCC charter. And if enough people pull fast enough, they become insolvent. And so that's what we're looking for right now. The other thing we're looking for right now is GBTC. It looks very weak. It looks like a bunch of people, lenders, have it on their balance sheet. Looks like they're trying to sell it. The spread on GBTC has widened to an all-time low, negative 42% to spot. It's officially trading under $10,000 per GBTC.
GBTC is the Grayscale Bitcoin Trust, which basically buys Bitcoin and you buy shares in the trust, right?
Right. And so the additional context here is in the summer, when Three Arrows blew up, one of their main assets was GBTC. And they were borrowing a lot of cash against GBTC from the big lenders, from BlockFi, from Celsius, from Voyager, whatever. After the fact, after the summer, these lenders were left with a lot of this GBTC. And it's their main liquidity asset. You look at their balance sheets and, it just has to be. Like there really is no other assets that they really could have. And you look at the chart and you just see everyday relentless selling. Like, what does that tell me? It tells me that they are also worried about bank runs. They're also worried about liquidity. And so, that's where we find ourselves today. If this GBTC discount keeps widening, that's a really bad KPI for the health of the space. Not long-term, but, short-term in terms of potential creditor overspill.
So has Barry Silbert responded to this at all? Has Grayscale responded? Have they been asked questions about this?
This morning.
And we should say, by the way, let me just say for listeners, this is Friday. We're recording on the afternoon of Friday, November 11th. But go ahead, Vance.
They have. This morning, they announced that they would put $140 million into Genesis to recollateralize it. What is my first reaction to that number? It's too small. You lost $175 million yesterday. And the day before that, you told us you had no exposure. You put in $140 million to partially cover the hole. Meanwhile, we can see the GBTC spread continuing to widen, implying that someone somewhere is selling a lot of this asset, which is theoretically most of your balance sheet. And so that is, the worrying state of the crypto credit markets that we find ourselves in today. The saving grace is that these things are much, much smaller than they were in the summer. The credit markets are much, much smaller than they were at the summer. The outstanding loan balances are much, much smaller, but it's still very fragile.
So basically, is there any place that you can short GBTC, or do you have to sell it outright?
Good question.
There is no redemption mechanism, so you have to sell it to get out. If it was a regulated ETF, you would be able to redeem for the underlying, and that's been a lot of the fight as to why DCG is pushing so hard on converting this. But yeah, there is not a whole lot of things that you can do with GBTC other than borrow against it or sell it or create shares.
So what are the consequences of all this for GBTC?
Like at some point, this will convert to an ETF, we think. We don't know. And so there's going to be somebody to step in who wants to buy Bitcoin at $1,000, but it's GBTC. But like, that's not just like, okay, all good. Bitcoin at $1,000 implies that the balance sheet of these lenders potentially has gone down by 90% from here.
Michael, do you want to jump in with anything?
No, I mean, one point of clarification is GBTC at $1,000, not necessarily Bitcoin at $1,000, because there is a mismatch here of what this financial product represents, which is supposed to be the value of Bitcoin, but it's been off its peg over the last year and a half. And, the discount has been a trade that a lot of people have been trying to make. Now the discount's wider. To Vance's point, maybe there's an arbitrager who wants to step in and try to make that trade. There are people that bought the Mt. Gox claims. I'm sure there are people that will buy the FTX claims here as well. But it's all going to have to get sorted out, and it's going to take time. And so, the state of the world is the state of the world right now. What Vance is effectively saying is we don't know when this ends. It's still happening. This is live right now. And it's not the FTX show, even though they declared bankruptcy either this morning or last night or filed for it. But what we're thinking about, what we're working on right now is what does this extend to? Where do the further dominoes fall? It seems like, the dominoes that happen, and we saw this too with Three Arrows and Celsius in June, the dominoes here are just going to be smaller in nature as we progress. And so I think generally we're going to see like less and less as we continue forward. But I think it's important to note that this is not over. It's happening currently, Friday afternoon. This will probably happen for another couple of weeks, maybe a couple of months. And when the dust settles, we'll be able to assess.
So what about an exchange like Binance? What are we seeing there? Are people pulling their money out?
Binance and Coinbase are kind of like the two safe. Coinbase is the one that we use. Like we consider it very safe. It's qualified custodian, not financial advice, all that stuff. Binance is like the or no regulated international exchange that's just gigantic. They've been publishing their version of transparency, which I actually think is pretty good. It's called Proof of Reserves. And they basically say, here's how much balance sheet we have in Bitcoin and ETH. And you can see that customer funds are one-to-one backed, and there's no potential for a run in the bank. So not really concerned about Binance, but there's a lot of smaller Asian exchanges, Huobi, Bybit, OKX, people that run pretty fast and loose, KuCoin, that have had issues in the past where, like this is one of the main learnings from the summer is that it doesn't happen in one day. Like it takes like a week for people to turn around, realize there's a hole in their balance sheet, try to sell, try to get out. That causes more liquidation. That pushes somebody else into the same position. And so it'll take time. BlockFi announced bankruptcy last night. It's going to be a little bit.
Why did I think BlockFi? I saw that, but why did I think that BlockFi had already gone bankrupt?
Because they almost had.
You had thought BlockFi already went bankrupt because FTX bought them. Meanwhile, all of customers' funds that were deposited into BlockFi, both before and after the quote unquote bailout, were custodied on FTX International. And let me tell you where those funds are. Those funds are fucking gone. They're with Alameda. Like, fraud. Like, this is crazy. Just nuts.
Incredible. So before we get to, implications for regulation and DeFi, a conversation about DeFi as well, just to tie this off, what do we know now? So FTX has filed for bankruptcy. I guess Alameda is also, all the companies associated filed for bank. There's like 100 and something companies associated with Sam Bankman-Fried. He's also something else we didn't talk about here, but he himself is an investor in tons of other companies. Robinhood and venture fund Sequoia. I saw a report that he's put $500 million at least into a variety of venture funds. Again, I don't know. There's so many numbers coming out here. Where is he now? Like, what's the state of play with Sam?
To be honest, one of the things that we did yesterday afternoon, just because we wanted to see what it looked like, is we started doing FlightAware over the Bahamas just to see what planes were coming and going, what private jets were leaving. He grew up in California, in Palo Alto. His parents are law professors at Stanford. This is going to have ramifications very, very deep into communities that weren't necessarily his. So he's on the run. That's basically all we know.
Imagine, first of all, I don't know anything about his parents, so I don't want to add fuel to the fire. But I was just going to say, imagine being a law professor and your kid being like the next Madoff. He's the Madoff of this cycle.
Almost as big as Madoff.
It's tragic. It's truly tragic. And honestly, like, we don't even know who he has defrauded. Like, what kind of individuals want their money back? Like, he's not the safest person on the planet to be around.
Nope.
We heard people were gearing up and flying to the Bahamas, over the past 2 days, and not people you'd really want to mess with either.
I mean, maybe he ends up like Hyman Roth in the Miami airport.
I mean,
coming back to the U.S. after everything else failed, only to get, I don't want to say it, but man, I mean, this is no joke what he's done.
It's one of the largest financial crimes in history, period.
Yeah. So I know that Michael is going to have to drop in a few, so maybe you and I can keep going, Vance, on the premium feed, but let's just talk if we can, and maybe you can give us your final thoughts, Michael, on what the fallout is. So we talked a little bit about, where we are in the fog of war. We don't know yet. There are a lot of potential dominoes yet to fall, but there's also the political backlash as a result of this, especially because SBF was so prominent. I mean, he had that great Super Bowl ad that ran with, what's his name from Seinfeld. They renamed the American Airlines Arena FTX down in Miami. I mean, he was just everywhere with his gross, shorts. I mean, that panel of him with Bill Clinton and Tony Blair, where he's just there with like sweatpants shorts, is disgusting. But it's this weird thing where I feel like for him, he is the kind of the latest and greatest. And this story is kind of a combination of like MF Global, John Corzine, because of the customer deposits, Elizabeth Holmes, because of the carefully curated image, even though, she was in a turtleneck and he's like this slob kind of dressed in whatever. I don't even know how to describe it. Tennis sneakers and the shorts. And on top of it, you've got all this Ponzi Bernie Madoff aspect to him. He's like a perfect composite. So what do you think the political backlash is here, given how important he was, given all his political connections?
The ramifications are going to go deep is really what is going to happen. What this means, DCCPA effectively is dead for now. Some of the major supporters of it have come out and said, we're going to have to take a fresh look at this. New Congress is already, in the works right now. So probably not going to be something that even gets revisited until mid 2023 at the earliest. What this means for some of the people that were supported by him, they're going to have a really tough conversation going forward. They're going to have really tough conversations with the staffers that were, propping him up and bringing him in as a donor. They're going to have tough conversations with their other donors who don't want to be affiliated with this. And they're going to have a really tough conversation with their colleagues in different, committees or institutions that they're associated with, because they're going to have to answer all of these questions to everybody. I think ultimately we're going to have new leadership in the narrative building of what this industry is. Framework is going to be right there pushing forward, just with a number of other institutions as well. We're going to have to take a fresh look at everything. And it's going to be really exciting to, once all of this has died down, build it back up in a way that is much better and safer.
Vance, any thoughts before we go to the premium feed?
I completely agree with everything that Michael said. I think our message is that we have a plan for the industry. Like, we are funding games that are working, that are starting to play out for our thesis, that are going to bring hundreds of millions of people on chain. DeFi is ready to scale. It's ready for mainstream adoption. People finally have a reason to use it. Ethereum is deflationary. It's the first sustainable internet money that's ever been created that's highly levered to a digital ecosystem that's growing quickly. Like, the space, the thesis, everything is very much intact. We are Ethereum people. Our sense is that SBF and Solana and all of those people just burned down their corner of the industry. And now it's just time for new leadership. Who is new leadership? Michael and I have always tried to be side characters and good stewards. I feel like we have to step up, be more main characters, and just be good stewards for the space. And, that is what it is. A16Z, us, projects, there's not a whole lot of us, but we're definitely ready to pick up the flag and run with it.
All right. So that's what we're going to talk about on the other side of this conversation, Vance. Mike, take care. I know you got to run, and thank you so much for joining us. And we'll catch up later. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Vance, as well as the episode transcripts and intelligence reports, head over to hiddenforces.io and check out our episode library, where you can also become a premium subscriber today. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription. available through the Hidden Forces website at hiddenforces.io/subscribe. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation on Twitter at hiddenforcespod or send me an email at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.